Hi, this is Priyanka Chopra and you're watching Channel Y.
The biggest South Asian media group, Y Media.
Y Media Group, established in 2001, is a media company with a 360-degree approach in reaching our audience over 5 platforms: television, radio, newspaper, online news portal, and mobile app.
Y Media has newspaper, midweek, radio, South Asian pop.
Hi, I'm Amitabh Bachchan, and you're listening to South Asian Pulse.
Hi, this is Amir Khan, and you're listening to South Asian Pulse.
All English 24/7 television network and Y Media Plus.
You are watching Channel Y. Channel Y.
Y Media Group's Ground Zero Report. From Parliament Hill to Queen's Park, to Y Media's studios.
Prime Minister, welcome. It's a pleasure to be here. It's a pleasure to be back.
Y Media is the official media partner for TIP. This is an exclusive show all about the Toronto International Auto Show.
So Cam's going to tell us more about the amazing vehicle.
Hi, this is Yalla Kampal with Y Media. Today we are here at the 2023 Canadian International Auto Show. We're going to
Hi, I'm Ria Khan, and on behalf of Y Media, welcome to Channel Y.
Y Media Group welcomes you to Channel Y once again.
Host Ramona Singh, and it's always great to start the show with you.
Hi everybody, this is Yalla Kampal with Y Media. Today
Channel Y के entertainment special में जहाँ
Hello, Sat Shri Akal, Namaste, and Adab. This is Kripa Anand, and you're watching us on Channel Y.
everyone, this is Pragya Devan and you're watching me on Y Media.
This is Vinay Sharma, reporting from Chandigarh, Channel Y.
Online, SouthAsianDaily.com. The biggest South Asian media group, Y Media.
Hello everyone, my name is Yudhu Jaswal. I'm the group editor at Y Media. Today, one of the major concerns that Canadians and I'm sure many other parts of the world we are facing is inflation, housing crisis. Will the Bank of Canada cut its interest rate this year? Yes or no? If I look at The Economist, the opinion is divided. You talk to any financial planner, the opinion is certainly divided about inflation, housing, Bank of Canada. But today we have a very special guest here. We'll discuss all these things. Where are we heading towards in 2024? I'd like to welcome ANDREI BRUNO. ANDREI, a very warm welcome, sir. How are you?
I'm doing very well, thank you. It's fantastic to be here.
You are very welcome, and ANDREI is with the FIDELITY. He's been there for quite some time now. We'll talk about details about the company, about him as well. But ANDREI, you know what? You've been in this business for quite some time now. I want to ask you, what is your take on this inflation? Just for viewers' benefit, I'd like to tell them once again, the November number were 3.1%, but it got a little bit up. The December number came out as 3.4%. Where do you see this going in 2024?
Yeah, so certainly inflation's been a wild ride over the last couple of years. We first started, it feels a couple of years ago now, where inflation was slowly creeping higher, and this is after about a decade of basically no inflation. Central banks across the globe are trying to, fuel some inflation, get us off 0% inflation with a lot of monetary policy, a lot of stimulus from a monetary perspective, and then, all of a sudden, kind of the perfect storm. We had, central banks had to cut interest rates because, obviously we were in COVID and there was a, downturn in the economy, but at the same time, supply chains were constrained, and that kind of made this perfect storm, and we got up very high, single digit, in certain jurisdictions in the globe, double digit inflation. So now we've come a long way. As you mentioned, we're, getting towards that 2% target, but we're still above it. As you mentioned last month, it was still ahead of kind of what economists' expectations were. So a bit of surprise, but I think, what most people are expecting for 2024 is that we will see that rate get to that 2% target. Now, when you think about Canada as well, the main thing that's, maintaining this slightly higher inflation rate is the services component. So again, you can break it down roughly into goods and services. Goods inflation has been relatively tame for quite some time now. It's that services component. There's a bit of a positive feedback loop there. So, inflation goes higher, folks demand higher wages. We have a very tight labor market. Unemployment rates are still, relatively low. So that places upward pressures on wages, which then gets filtered down into higher prices. So we're starting to see that services component start to calm down now as well. So by year end, I would expect, us to hit that 2% inflation target here in Canada.
Okay, that's good to know. I'm sure that's going to benefit a lot of Canadians. Now, if when I read statements from financial planners, any people in the corporate level, or economists as such, the opinion is once again quite divided. Many of them are saying the Bank of Canada would cut the interest rates this year, but then when would it cut? Very few percentage saying in March, there are others who are saying in April. Some people say maybe in June, some people say, and I have asked a few financial planners, advisors, economists who are saying no, not at all. So I'm sure our viewers are more confused after listening to all these statements, but I want to ask, what's your take? Will the Bank of Canada cut its interest rates? Yes or no? If yes, when do you expect? And your reasons for that?
I think we will get some cuts sometime this year from the Bank of Canada. I think what's very important on whether or not we get those cuts, I think we do need to see that inflation number get very close to that 2% target. I think it'll be very tough for the Bank of Canada to cut interest rates in the absence of getting to that 2% inflation target. If you think about it, their main core mandate is to contain inflation. So for me, it would be very tough for the bank to say, we haven't really tamed inflation, we haven't really achieved our goal of 2%, but here we are cutting interest rates, which in theory could fuel future inflation. So again, I think we're going to get to that 2%. So if we do get to that 2% and we do experience an economic downturn, I think there's good impetus for the Bank of Canada to cut rates. Now, if we take a look at the Canadian consumer has a lot of debt. I think we're somewhere around 170, 180% personal debt to income. That personal debt does not include mortgages. It's simply credit cards, lines of credit, auto loans, things of that nature. So the Canadian consumer is quite levered. If you look at the United States, they're around 130%. So we've got a lot more debt. You add in mortgage debt, which we know what the mortgage market's done, what the housing market has done over the last several years. These higher interest rates coupled with this increase in inflation rates is really putting a strain on the Canadian consumer. Obviously, cutting interest rates will give the consumer a little bit more breathing room. We are very sensitive to interest rates, so it would help the Canadian consumer. So again, I think if we do get to that 2% target or very close to it, and we do experience that economic downturn, just to remind viewers, we did get a negative GDP print in Q3. And the technical definition of recession is 2 consecutive quarters of negative GDP growth. So we will get some Q4 GDP estimates very soon. If those are negative, that will also, give the Bank of Canada a little bit of impetus to cut interest rates as well. Right now, if we take a look at what the market's expecting, they're certainly pricing in rate cuts. I think somewhere around 5 rate cuts for the year is what the market is currently pricing in. Now we can sit around and debate on exact timing. If I was a betting man, I'd say probably sometime late in Q2, maybe early Q3. Again, this is really dependent on what the economy is doing and what inflation's doing.
Just to add on to your point that you just mentioned, yeah, you're right. I mean, we have the Q3 numbers, Q4 would come out soon, but we also have the numbers for 2024 as well. I want your take on the economy as well. I don't think so we're going to grow, maybe 1%, less than 1%. I doubt we're going to grow 3%. I don't think so. So where does Bank of Canada stand with all these numbers and your take on the economy for 2024?
Yeah, I think the biggest challenge for the economy in 2024 is the consumer. We mentioned those consumer debt levels. If we think about developed economies, of which Canada is, the greatest. If we think back to our economics 101 class, you've got all these inputs. Consumption, investment, government spending, net exports, which all factor into the GDP equation. Consumption in developed economies is 70 to 80%. So when the consumer is struggling, obviously the consumption part of that equation gets hurt. And again, we are seeing that if you take a look at the retail sales numbers, certainly in the goods sector has been kind of quite sluggish. Services have been chugging along, so just think about going to restaurants and other services. So again, we're already starting to see it in the retail sales number. Again, with these elevated interest rates, we think about the mortgage market, we've got a lot of folks who are getting renewals in 2024, even more so in 2025. Even if we do get, let's say, 100 basis points or 1% cut from the Bank of Canada over the next year, there's still a lot of folks upon renewal are going to experience a higher payment relative to what they were paying when they locked in, 3 years, 5 years ago. So I think we're going to continue to see a strain on the Canadian consumer, even in the event that the Bank of Canada does cut interest rates. And I think that's going to obviously, funnel into the overall economy, and consumption is going to continue to be strained over 2024. So again, I don't think the prospects are super good for the Canadian economy in 2024. Again, the other bogey here is employment. Obviously, if we see a wave of layoffs, unemployment is going to further exacerbate our economic headwinds for 2024.
How much, you mentioned twice just now the consumer debt. How much is of that of a concern to you? Because as you write, and we're seeing so many figures coming out, 2024, a lot of people were getting the mortgage renewal, then 2025 as well. So it is a concern for sure, but how much is that of a concern? Will there be many challenges in the housing market? Will be so many more delinquencies? How much of that is a concern?
Yeah, I would certainly expect delinquencies to go up a little bit, but if you take a look at kind of where delinquency rates are, and they're still quite below kind of historic averages. So there's not, there aren't alarm bells ringing here. The other thing you have to factor in is demand. We have a ton of demand for housing. Obviously, our immigration levels are remaining high. There's a lot of new people coming to Canada. So again, it would be tough for me to see a scenario where we have, a tremendous housing market crash. Not to say we can't have some sort of correction, and certainly we have seen housing prices cool off in certain jurisdictions. Anecdotally, Toronto have obviously seen a cool down. We're off kind of peaks where we were a few years ago. But again, just all the demand for housing, I don't see how we could have a early 90s type crash scenario where we're down 40% on housing. So again, I think purely from a demand perspective, I think the Canadian housing market is resilient to a degree. If we think about the mortgage market as well, the banks are doing a lot of kind of getting ahead of it to some degree and working with borrowers to ensure to keep defaults down. So they are doing work from that perspective. Again, I think the Bank of Canada knows the structure of a housing market, knows how the consumer has a lot of debt, and I think that's another reason why I think we could see those rate cuts come down the pipeline later in 2024 or in mid 2024, which will again help the consumer, help them make those payments. And at the end of the day, the last thing folks default on is their housing. First thing that goes is typically credit cards, auto loans. The last thing folks want to default on is their home.
Yeah. Talking about the housing sector as well, it's a major contributor as far as GDP is concerned. But do you think, with the raise in the Bank of Canada overnight lending rate, the housing market from February 2022, it has come down? Yeah, give or take 1 or 2 months, it did go up. But do you think, the biggest contributor to our GDP, we're bringing it down intentionally or unintentionally?
Yeah, so certainly I think as a percentage of GDP, housing is at the highest, if not the highest, in terms of the contributor to GDP. So and that is another negative contributor to overall GDP. Obviously, with interest rates going up, demand for housing has dipped down. So that's obviously going to contribute to the headwinds for 2024. But again, I think there is a certain floor of where kind of houses can go. Obviously, in metropolitan areas, the floor is probably a little bit higher than maybe some, some more rural areas per se. And you saw that during COVID as well. There was, corrections in the housing market in Toronto, and it was felt a little bit more the further out you went. Similar in other metropolitan areas as well. But again, I think we are going to see a bit of a pullback in terms of the housing component of GDP. But again, I don't think there's going to be a major crash here. And again, the main component is still that consumption, which is also not going to be positive in 2020. Well, it doesn't look like it will be positive in 2024. Unless absent we get this soft landing scenario, maybe Q3 was just one negative blip and we get back into growth. But I think there's just a lot of headwinds out there that wouldn't be my base case for 2024.
Well, we'll carry on this discussion as well, but I'm sure there are many viewers who would want to know in these uncertain times, where do they want to place their investments? And ANDREI BRUNO, I want just for our viewers, but I'd like to tell you that he's a director at FIDELITY, one of the largest firms, financial firms in the world, and also you take care of the ETFs. Just
That's
for
right.
our viewers' benefit, can you explain what is ETFs? What does this mean?
Yeah, certainly. So I think most viewers are probably familiar with mutual funds. So ETFs are very similar to mutual funds in that you get access to a diversified pool of assets. Could be stocks, could be bonds, could be a mixture of the two. One of the main differences between exchange-traded funds, ETFs, and mutual funds is that, as the name suggests, they are exchange-traded. So you can buy them on stock exchanges just like stocks. So that's probably the main differentiating feature between an ETF and a mutual fund. And again, the ETF market is growing. We're starting to see new products, new innovations. In terms of what's offered in the ETF space, it's starting to get up there similar to the mutual funds. So we're starting to get into more exotic products like liquid alternatives, which had historically been kind of just in the realm of mutual funds. So it's been growing quite a bit, and ETFs were well over 20 billion in terms of inflows last year.
How do you compare, because when I get the feedback on radio or TV, this is a very common question from our audience, would we invest in real estate or in ETFs or anything like this?
Yeah, I mean, it's certainly, obviously, every market's different. What's working today might not work tomorrow. What's working this quarter might not work next quarter. But in terms of, some key differences between, let's say, ETFs and real estate is obviously liquidity. Liquidity is just a fancy word for saying how quickly can I buy and sell. So obviously with ETFs, if you want to buy today, you'll get your asset in 2 days. It settles 2-day period. It's standard in the business. If you want to sell, there's a lot of liquidity. You can get your cash back. Obviously, real estate, as you know, there's closing time. Takes 30, 90 days to buy and sell real estate. If nobody's buying out there, you might be sitting on your assets. So obviously, exchange-traded funds do provide an improved liquidity feature. You can even invest in real estate within ETFs as well. There's certain ETFs that do invest in real estate or invest in REITs, real estate investment trusts. So you can get real estate exposure even through ETFs or mutual funds for that matter as well. Again, in this particular market, an interesting trend that we're seeing right now. So a lot of people have shifted to cash products as well. So now a lot of people, this question is actually coming up now is, if the Bank of Canada can cut, what am I going to do with my cash now? What should I do with my cash now? So that is some conversations we're having with clients now.
Okay. And what are the trends as far as ETFs is concerned?
Yeah, so again, I'd say this year, and I'm going to touch on what I was just briefly talking about, we did see a big rush to cash products in the ETF space. So there was a lot of HISA ETFs, high interest savings account ETFs, that offered very attractive rates, often in a little bit of excess over the Bank of Canada rate. So again, fixed income, it's been a tough year for fixed income. Fixed income is just a fancy word for bonds. It's been a very tough year over the last couple of years for bonds. As interest rates go up, bond prices go down. So it's been a tough year. So there's been people have been very attractive to the cash nature of these HISA ETFs, and we've seen a ton of money flow into those particular products for the last 2 years. But now all of a sudden we're in this scenario where, okay, we've reached potentially the peak interest rates. If anything, the Bank of Canada is going to cut interest rates, and interest rates are going to go lower. So now I'm going to get less yield on my cash. So now folks are starting to talk about, is it time to get into bonds? They're finally offering attractive yields that we haven't seen in over a decade. It feels like we've been very close to zero interest rate policy since 2008, it seems like. So bonds have been relatively unattractive from a yield perspective. So people are starting to get interested in bonds now, and that is a lot of conversations we're having with clients now, talking about, should we get allocate some of that cash position over into more bond products.
You're talking about fancy words, and strategy is another fancy word, because when I talk to many financial planners or advisors, they will say, let's build a good strategy. I said, what is a good strategy? So that's what I want to know from you as well. So what are the investment strategies at Fidelity that you're saying with regards to ETF, and if you could touch upon how they're any different than other strategies?
Yeah, for certain. And I'll touch on a solution that was fairly popular for us last year. So our all-in-one suite. So these are multi-asset products where we kind of take care of the asset allocation for you. Asset allocation is just a fancy word for, how much should I have in bonds and how much should I have in stocks. So we have a full suite of these products that go from, 60-40, 80-20. So depending on your risk tolerance and what your goals are, we've set the asset allocation to achieve your goals. Again, if you're, maybe you're getting on in the years and you're getting ready for retirement, you might need a larger allocation of fixed income, which has historically been seen as a little bit safer than, say, stocks, which are more volatile, move up and down. We hear about stock market crashes all the time. So the great part about these products is a one-ticket solution. We take care of that asset allocation for you. You don't have to worry about picking the wrong stock. You get your diversification. You don't have to worry about rebalancing your portfolio. That's all done within that low-cost one-ticket solution. So again, these have really resonated with clients. Kind of a set and forget it strategy. You get all the asset allocation. There's some security selection that's happening. So we've got whether it's our models or our portfolio managers managing our underlying funds within there that are picking stocks or picking bonds to try to get a good performance outcome for you. That is our goal ultimately. So again, those are really resonating with clients. Makes it very easy. You get diversified, whether it's within stocks or whether it's within bonds and across asset classes.
Good points. I was just watching, quite a few interviews from Davos. One of the things I like about the Davos Summit is that you get all the business leaders, many senior corporate executives like you. They're there, many elected representatives as well, and you get a good perspective of what's going on at the world level. If I may ask you, much of these things are quite connected. What we're seeing, there are clashes in Middle East and then in Europe as well, and I'm sure that's going to affect the business. So when people listen to all these news, they want to get a sense how my investments would work, why I should put investments where. So your take on what are the challenges that we're facing from the investment perspective, and of course the global uncertainty, how it will affect.
Yeah, of course, geopolitical risk is always kind of this bogey, right? You never know when something's going to crop up from a geopolitical perspective, and obviously, with this global economy, it's no longer, what's happening over there doesn't matter over here. Obviously, if you think about the Middle East and any geopolitical risk there, obviously that has implications for the oil markets, which obviously filters into what's going on over here in North America. Obviously, we use oil to heat our homes, to petrochemicals and what have you. So the world is very interconnected, and obviously we keep a keen eye on what's going on in the world. Obviously, our portfolio managers and analysts are keeping a keen eye on the macro environment, and it's obviously important to pay attention to that. Obviously, when it comes to closer to home, obviously what's going on in the Canadian economy, what's going on in the U.S. economy, because ultimately, it depends where your investments are, of course, right? Obviously, to Canadian investors, we don't just buy Canadian securities, whether that's bonds or stocks. We're obviously invested in the U.S. market, international markets. So obviously, we have to keep a pulse on kind of what's happening globally and what's going on. Making relative value judgments about what's going on in Europe versus what's going on in the United States. Should I allocate more capital to Europe? Should I allocate more capital to the United States? Obviously, we have a massive investment team that deals with that, whether that's folks who have focus on North American mandates or Canadian mandates or European mandates, or even our asset allocation team that tries to make those tactical calls from a top level and saying, what relatively looks good? Does Canada look good? Does the US look good? Do stocks look good? Do bonds look good? And they make tactical allocations around that to try to get the most bang for your buck and earn the most on an investment in terms of what's going on in the world.
You talked about a lot of investment strategies. Before we wrap up this interview, thank you for sharing that. But for our viewers, where can they get access to these investment vehicles?
Yeah, so for sure. So, when you're talking about, ETFs broadly speaking, obviously you can buy those on stock markets. So any way you can buy stocks, you can buy ETFs, whether that's through your discount brokerage, through your financial advisor. Obviously, if you want to get some more information about Fidelity and what we do and what solutions and products we have, you can visit us at fidelity.ca. is probably the best spot to get more information on us. But again, if there are any questions, I do encourage the viewers to, in fact, go to fidelity.ca or talk to a financial professional as well.
All right, before I let you go, I'm just tempted to ask you this question. No one has asked me, but I was curious to know. Let me hear it from you. If I look at the last 10 years, numbers for Bank of Canada, it has never touched, before February 2022, the overnight lending rate had never touched 2%. It was 1.75, 1.5, 0.25. So I was quite curious to know why would suddenly, I know the inflation part, 8%, 6%, fine, but why would you raise the rate at such a fast level from 0.25 suddenly 2, 3, 4, 5%? Why did we do that? One part of the question. Second part of the question, and now I'm asking this question because I ask anyone from 5%, I mean, because you just mentioned earlier the targeted is 2%. I thought finally somebody is saying targeted, but I know you were talking about inflation.
That's right.
Yeah, you're right. So second part of the question is, first is why did they raise so quickly? Because in the last 10 years I never saw this. Second part I want to know from your viewpoint, why are we not targeting back to 2% or less, which has been the case for overnight lending rate in the last 10 years? I've looked at the numbers from 2013 to 23.
Yeah, so the first question first. I think what happened is I think they got a little behind the ball.
Okay.
I think they should have started raising rates a little bit earlier. And there's this notion of there's this neutral rate of neutral interest rate, and the neutral interest rate is essentially, it's mathematical, it's calculated, it's estimated, but it's basically saying, if we're at the neutral rate, we're it's not, the monetary policies are not loose, it's not tight, it's not stimulative, it's not accommodative. So during COVID, we certainly went into stimulative. And I think what happened is instead of slowly getting it back up to the neutral rate where we're not quite stimulative, but we're not quite tight monetary policy either, they waited. And then we got a surge of inflation, and I think they said, whoa, we're kind of behind the ball here. We got to play some catch up. And I think that's why we saw interest rates go so high so fast. So personally, I think it would have been a little bit better if we, maybe hiked a little bit when we saw things are getting better and you get a little bit towards the neutral rate. Because the other thing is it takes time for monetary policy to filter into the economy. There's anywhere between a 12-month to a 2-year lag of, when the bank raises and when we start to feel it. Obviously, in the mortgage market, you can see how that conceptually makes sense. Obviously, it takes time for people to renew and before those hikes can actually filter into the economy. So it's my opinion they just waited too long, and then all of a sudden they said, we're behind the curve. Now we got to hike and go fast. So in terms of your other question, which is, do you think we're going to get back down?
No, I don't think so. That's my question. My opinion is I think from 5% around by 2025 December, I think they could be overnight lending rate, could be. This is what I'm reading everywhere, 3%, 3.5. So I have no opinion, but I have a question. Why aren't we targeting back to 2% ASAP? Because that was the case for the last 10 years. That's my question.
I think why they would be hesitant to cut and get back down there so fast is the worry that we stoke inflation.
Okay.
So I think we've had 2 years of very hot inflation. And what people need to understand is even if we get to 2%, even if we get to 0% inflation, all that other inflation is still here. Our prices are still high. It doesn't mean our prices have gone down. It means they've stopped going up.
Yeah.
So I think their fear is if we do cut and we get all the way back down there and we stoke inflation again, I think the bank will lose a lot of credibility. Because again, it's their job to maintain inflation. In Canada, we actually have a band, 1% to 3% is the band that we target. To contrast that with the United States and the United States Federal Reserve, they actually have a 2% target. We have a band, 1% to 3%, but most people, we average it out to the 2%. So again, I don't think I think they're going to be very hesitant to cut that much. I think they're going to cut as much as they need to. I think it's possible, not to say it's impossible that we won't get to 2% mortgage rates again at some point, but I think there's probably some appetite to keep rates a little bit at more healthier historical levels and get off that 0 to 2% range. I think from some of the rhetoric I've been hearing from the United States Federal Reserve, it seems like they have a lot of appetite to keeping interest rates more historically healthy levels and get off that 0% bound.
All right, finally I got that answer. Thank you for clarifying that. One last question, if I could squeeze in. We're talking about economy. China has been one of the countries for the fastest. I haven't seen any country grow that fast, but they're having challenges today. Of course, I saw Xi Jinping going to US. They're trying to get their economy going. India is fine, 6-7%, but Canada, US, Europe, Middle East, they're almost everyone is struggling. I want to know mainly about Canada. If someone would ask you, what should we be doing to make our economy go up? What strategies would you employ?
Yeah, for sure. I mean, obviously, immigration has been contributing positively to the Canadian economy. I think we need to focus on productivity. We're not quite as historically, we haven't been quite as productive as the U.S. When we're taking a look at productivity metrics. So obviously, trying to increase productivity. I think if we're thinking very long term as well, thinking about what the future is going to look like. In terms of what products and services can Canadians offer. It feels like if you think about the early 90s and how much manufacturing we had, I feel like a lot of that has gone. Obviously the economy has changed. But the question for Canada is what's the economy going to look like in 20 years and how can we position ourselves to be competitive? So again, I think there's probably people a lot smarter than me that are contemplating this question. Obviously immigration will continue in Canada. We have a massive country. We have tons of natural resources. We have tons of room for new Canadians to come in and help us grow. And in fact, we've been doing that for the last 10, 15, 20 years. So I think we'll continue to do that as well. But again, I think focusing on how can we be more productive and how can we shape Canada for the future. Now, I don't have a specific answer for you. I think you're probably looking for a very specific answer. I don't exactly know what that looks like. Again, we're going to see a big shift. Obviously, AI is coming, and that's going to revolutionize kind of the economy. Is that going to take 5 years? Is that going to take 10 years? Is that going to take 20 years? That I'm not sure. But I think Canada needs to, try to take advantage of that and try to adapt to that environment and be at the forefront and an economic leader when that does come.
Andrei, I must say, pleasure talking to you, and I thoroughly enjoyed this conversation. Anything else you want to add before I let you go for our viewers? Please do so.
Yeah, I'd just say, it's ideally, we had a pretty decent year in financial markets last year. Here's to hoping it continues this year. Obviously, with the headwinds that the Canadian economy is facing into 2024, I think folks just need to be, cognizant of that and be prepared for a potential downturn in the economy. So get your rainy day fund going. Because, based on what I'm seeing here, the base case is that we could potentially head into a recession. Hopefully it's just a gentle one and we get out of it, and by, the holiday period in 2024, we're back and happy. But just want folks to be prepared for any scenario, but specifically if we do get into a recessionary environment.
Okay, thank you so much, and we wish you all the best. Thank you.
Thank you for having me.
Yeah, looking forward. I hope you enjoyed today's discussion. Thank you so much for your time. Any details are there on your screen. That's all for today. Keep watching Channel Y. Thank you.
The biggest South Asian media group, Y Media.